Hello, my friends. Hey, it is John Lone King. It is Friday, the 8th of May. Super excited to be coming to you today. Got lots of information to talk about, but I really have one very important theme. Let's all agree to stop guessing on mortgage rates. We've been getting it wrong all along. Really, for the last 6 years, it has been impossible to predict mortgage rates. It was, I guess, pretty easy in 2020, in 2021, and 2022 to guess where interest rates are at. But was it? Because there were days when interest rates would go from 2.5 to 3.25. And everybody thought the world was coming to an end because rates had gone up to 3.25. If only we knew. But the truth is you can't predict interest rates, and we need to stop trying to do it. We need to basically understand that interest rates are going to go where they're going to go. And you need to just focus on what are my options. Am I at a good place and a good time in order to buy a home and be secure in the knowledge that I can make the monthly payment? It may not be comfortable. It may not be what you were hoping to pay. It may be more than what you're paying in rent. But it is about, is this the time for me to do something? And it's not about where are rates at and can I predict where rates going to happen tomorrow. So let's talk about rates, though, just like I do every week. Rates are very headline driven right now. Very headline driven. It is all about Trump and Iran and oil and the war and the Strait of Hormuz, and all of that stuff is what's driving interest rates. And there's not a whole lot that we can do about it. Okay, we've got some significant volatility every single day with interest rates, and it has to do with, well, I don't know, is there a peace deal coming or not? Did another ship get attacked in the strait or not? All of these things are out of our control. And the truth is, when you're looking to buy a home, you can't plan what day a news article is going to come out, a headline is going to come out, compared with the day you get your offer accepted. So you have to be willing to operate in a range. You have to be willing to say, hey, I get it. I get that, everybody every day says, John, what's the lowest rate you can get me? Well, today. So let's not approve you on that lowest rate, because if that's the only number you're willing to buy at, who knows if rates go up a little bit? Are you going to abandon your home search in the middle? That's the thing that you've got to really understand. Now, I'll tell you, one of the biggest things that updates rates every single month is the jobs reports. So first Friday of every month, unless the Friday is a first, and then in that case, there isn't enough time necessarily to get it out. So first Friday of every month, which this Friday is the day the jobs report came out today. The good news is unemployment held steady. It looked like there was a lot more jobs created than previously, but they revised prior numbers down. So basically, there wasn't a huge amount of job creation. But the truth is, it's not really driving interest rates right now. It's not enough of a difference. The Fed is worried about inflation. The Fed is worried about, and the Fed's changing of the guard is happening right now. I talked about that a lot more last week, but the Fed's worried about inflation. There are some Fed members that say we should be raising rates right now. Others that say we should be dropping rates right now. It's the most divided Fed we've had in decades. Okay, so we're up for a wild ride. Trying to predict interest rates is not the way to do it. Now, we have some good news, which is that the spread of mortgages, I'm not talking about Mayo and Muster. I'm talking about the difference between a 10-year treasury and a mortgage rate. That normally is a certain spread, a certain distance apart. Right now, the 10-year treasury is in the low fours. 30-year mortgage rates are in the low to mid sixes. So we got about a 2% spread between those numbers. And it had been higher before. So what we are looking at is previously, in 2023 and 2024, when the 10-year treasury was right here, we were over 7% in interest rate. Instead, we're in the mid sixes, maybe pushing into the higher sixes, but we're in better shape than we had been. So therefore, it really is softening the blow compared to what it could be. Now, that's kind of like somebody saying, my gosh, rates are great compared to the 18% that they were back in 1980. I'm sure you can say that. The reality is I wasn't buying a house then. I don't care about what it was then. I wasn't buying a house in 2022 or 2023. I don't care that it hit 7% or 8% or 8.5%. What I care about is, what are my numbers today, John? And the reality is they're going to change every single day. We're in the mid sixes on average. And depending upon the circumstances, it can be higher or it can be lower. But here's the truth. There are still a lot of buyers out there. If you're a seller and you're like, oh my gosh, these rates are destroying the market. No, they're not. There's a lot of buyers still out there shopping. Every single day, I'm getting more buyers reaching out, wanting to buy a home. But they're being pickier. They're being more selective in what they're willing to spend on a home. They're being more selective in the condition of the home. They're asking for credits from the buyers. We have to find ways to get creative to make deals work in today's market. But when you've got a great real estate agent and a great lender, right here, okay, I'm the guy, then we can strategize and help you make it happen. And that's the key, is strategy, because you also have a lot of other people that are out shopping right beside you if you're a buyer. And for most homes, you're going to be one of the few people that are writing offers, and you're likely to have some strength. But for some of the best price, best condition, best neighborhood homes, you're in competition with a lot of other people. So don't sit back and think, hey, it's no big deal. It's a buyer's market. Okay. Now, here's the reality, though. Affordability is still a major, major problem. Like, we've got an issue with people being able to afford a monthly payment. I remember back in, here I am showing you how old I am, back in 2011, 2012. Yeah, guys, I'm only talking 14, 15 years ago. But back 15 years ago, I had many people telling me, John, we don't want to qualify with both of our incomes. We're married, but we just want to make sure that we're comfortable with just one person's income. And that was true. That was able to happen back then because, first of all, prices had dropped significantly because of the 2008 financial crash, and housing prices fell, and yet incomes hadn't dropped significantly. Those who still had a job, again, unemployment only got to like 10%. So 90% of the people still had a job. And they were worried that what happened to their parents, their uncle, their grandparents, in losing a home during the 2008 financial crisis, they were worried it's going to happen again. And so they were able to, like, affordability was super low. It was super good. The ability to afford a home was high, however you want to spend that. The fact is that homes were affordable. You could have a married couple saying, I only want to, let's just be safe and make sure we're qualifying just on one of our incomes in case the other one loses their job. That is not a scenario that is reasonable today. It's not. Matter of fact, we have a lot of people who are still losing their jobs. We're seeing a shift in the economy. I don't think or know yet if it's going to be a bigger issue or not, but we're seeing fewer jobs created. We're seeing more jobs being lost. And so the question becomes, how do we make this more affordable? And a lot of it has to do with house hacks. It has to do with thinking about, hey, maybe I'll buy a home and I'll rent out some rooms. That doesn't help you qualify, but it helps you afford the payment. Because what I'm finding more often is people will qualify for this amount, but only willing to spend this. But it's going to take somewhere in the middle to actually get a home that is in a reasonable neighborhood that they can be willing and feel safe to live in. And yet they're saying, John, I only want to spend $3,000 a month, no more. And I'll let them spend $4,000 a month, but the house they really want is like $3,600. Well, how do you make up that $600? Maybe you convert the garage into an ADU. Maybe you rent out a room or two in the house. Obviously, it depends on your living situation. But these are the things that we have to be thinking about as buyers. And I've got a lot of realtors that are on this pod or on this video that listen to my videos. And it's the same thing you've got to be talking to your buyers about is, hey, maybe there's a temporary solution to make this work. And so that's a really important thing to understand. Just recognize the good news is all this inventory that we're seeing right now is giving buyers options. So maybe you can think about buying a multifamily home. Maybe you buy a duplex or a triplex. I'm seeing more people trying to go down those roads as well. Some other good news really quickly, talk about some programs before I wrap up here. Number one is we're seeing more assistance programs moving into middle income. It used to be that assistance programs, down payment programs were for low income. And you had to be below 80% of the area median income. And who can afford a home and a house payment when you're that low of income? And now there's a lot more middle income programs. There's a lot more programs that have no income limits to help you with down payment. I've got many of them. And so you would think, my gosh, this person makes, $250,000 a year. Obviously, they should be able to save for a down payment. Well, walk a mile in everybody's shoes. Like you're taxed a lot more at those higher purchase prices. By the way, I'm not complaining I'm not saying that, oh my gosh, it's so horrible. These people that they make, $250,000 a year, but you do have expenses that go along with your income. And you have rent that, hey, I'm making this amount of money. I want to live in this kind of a neighborhood. I want to buy this price of a home. Well, you're also renting a more expensive home. It's all relative. And so some of these programs that say, oh my gosh, you have to make really, really low income of yesteryear just aren't hacking it anymore. But that concept is still out there that everybody says, oh my gosh, down payment assistance is only for people that are low income. And that is just not true. And that's what I'm trying to make sure that you fully understand. So what matters is loan strategy. Okay. So when you think about, oh my gosh, John, what's happening with interest rates? Let's look at what's happening with strategy. I locked in a loan for a client yesterday at 4.99% interest rate. Now it was an adjustable rate mortgage, but they were willing to take that risk. It's a risk. It was also a risk if they took the 6.25% rate and ended up having a payment that was a couple $100 a month higher, and they risked being able to afford it in the short term. They looked at their situation. They decided that was worth it to them. I'm doing very, very few adjustable rate mortgages. Now they're fixed for the first 5 or 7 or 10 years, but I'm doing more of them than I had before. I was doing 0 before, but the math is starting to make sense for people who are looking at, how do I make this work? Like, I really want to buy a house. Mortgage rates are not going in my favor, and I can't keep guessing when they are. But I think long-term they are. And so let's find a solution that gives me, instead of a temporary buy down that gives you 2 years of a low payment, the truth is you can't afford the 30-year payment anyway. Then go for something that gives you 5 or 7 years and you have a longer runway. Many, many people made the mistake of doing temporary buy downs, thinking, well, I've got a 30-year fixed rate, so therefore I don't have to worry about that whole adjustable thing. But then you got 2% off your interest rate for the first 2 years. Guess what? At the end of the 2 years, your payment has skyrocketed, and now you're in trouble. If you would have taken a 5-year adjustable fixed for the first 5 years, you would have had a 5-year timeline at that lower rate instead of only 2. So it's kind of something to think about, that we were willing to do a temporary buy down because we had a fixed rate. It was going to be a 30-year loan in the end. But it was still a payment more than you could afford in the end, or were willing to afford in the end. And so that's the key, is loan strategy matters. And I am for sure interviewing for the job of being your strategist, of being your lender, of helping you make these decisions. Speaking of making decisions, I want to share some great news as part of my transition to cross-country mortgage over the last 60 days. I'm learning more and more about our reverse mortgage division and programs, and I am certified to do reverse mortgages. And I got to tell you, reverse mortgages normally are for people in their early 60s, but we've now got some in-house programs through Cross Country Mortgage that we can help somebody as young as 55 years old. Yeah, we've got 55 years old to do a reverse mortgage. Now, reverse mortgages are a whole separate thing that I'm going to spend more time on other videos, not my weekly update, talking about how they work, what the benefits are, what the pros and cons are. I'm a huge fan of reverse mortgages, but I talk more people out of them than into them. There are lots of reasons why it's a horrible idea for you. But if it's a good idea for you, I'm going to help you understand it. I'm going to help you make it happen. We also do second mortgages that are reverse mortgages. So if you are in your early 60s and you've got a lot of equity in your home, you have a low interest rate on your first mortgage, but you want to pull cash out, but you don't want to have a monthly payment on it, a reverse mortgage second is a great option, and I can do those for you as well. Okay. So guys, really the key is not about focusing on the interest rate. It's about running the numbers. It's about finding ways to make it affordable for you. And rate is not something we can control. So it's really the moral of my story today and what I want to go into. For anybody who cares, no news yet on Dream for All. We are expecting results anytime. Obviously, we don't know when it's going to happen, but it was 60 days after the lottery closed back in 2024. Well, guess what? That 60th day basically puts us at the end of next week. Early the week after. So we're getting close to the same timeline that we had previously, and we're not going to get any notice. It could come out on Monday. Who knows? We just have to be patient and wait until we get the information, guys. That is all that I've got for you today. For those of you who are watching, I probably got about a dozen people watching across different platforms right now. If you have questions, feel free to post those questions right now. If you have a need for a mortgage, whether you're looking to purchase a home, refinance a home, explore options, reach out to me. Scan the QR code up above or click the link, and we will be here to help take great care of you, because I am for sure interviewing for the job of being your lender. So if you need help with something, look to me, look no further. I'm going to take great care of you, and I'm looking forward to having a great conversation and helping you figure out what your goals are and how to make sure that they come true. Thanks so much for listening. Have a wonderful weekend. We'll talk to y'all soon. Bye-bye.